In 1694, England was on the brink of collapse, its navy unpaid, its credit exhausted, and a king desperate for funds. That year, a radical idea was born, a private bank that would lend the government money in exchange for the exclusive right to issue banknotes. But this pact planted the seeds of future crises. King William III government was so broke it couldn't borrow another shilling. Enter William Paterson, a Scottish merchant with a plan. A private company would lend the crown £1.2 million at 8% interest. In return, it would become the Bank of England with the power to print money. The deal was struck, the Bank of England was born, and with it the national debt. The government got its war funds, but the bank got a perpetual interest stream from taxpayers. This was the first decision, trading sovereign power for cash, creating a debt that would never be repaid. By 1708, the bank faced rivals. To protect it, the government banned other joint stock banks from issuing notes. Chancellor Sidney Godolphin pushed this through, giving the bank a near monopoly on paper money. Competition was crushed, and the economy's fate was now tied to one institution. The monopoly seemed safe until 1720, when the South Sea bubble burst. The Bank of England was the only institution big enough to rescue the market, but it did so on its own terms, enriching insiders while ordinary people lost everything. The lesson: monopolies breed moral hazard. In 1797, fear of French invasion caused a run on the bank. People demanded gold for their notes, but the vaults were emptying. On February 26th, Prime Minister William Pitt ordered the bank to stop gold payments. For the first time, banknotes became fiat money, backed by nothing but trust. The suspension lasted 24 years. The bank issued £1 and £2 notes for the first time, changing everyday life. But inflation soared, and the poor paid the price as food costs rose. The pound lost a third of its value. A temporary fix became a long-term erosion of wealth. By the 1840s, the chaos of multiple banknotes led Sir Robert Peel to pass the 1844 Bank Charter Act. The bank was split in two. One part issued notes backed by gold, the other did commercial business. The goal was stability, but the rigid gold limit would soon prove catastrophic. The act failed in its first test. In 1847, a financial panic hit, and the bank couldn't lend because it lacked gold reserves. The government had to suspend the act to allow emergency lending. This pattern repeated in 1857 and 1866, proving that strict rules couldn't contain panic. The 1866 Over-in-Gurney crisis was a turning point. The bank refused to bail out the giant discount house, letting it fail. But the resulting cascade of bankruptcies forced the bank to realize it must act as lender of last resort. The bailout doctrine was born. Fast forward to 2007. The Bank of England faced a modern run on Northern Rock. Governor Mervyn initially refused to bail it out, but within days, he reversed course, pumping billions into the bank. The message was clear: no bank was too big to fail. The bank's balance sheet exploded from £80 billion to over £400 billion. Bailouts became the norm, and moral hazard was institutionalized. The final decision that made disaster unavoidable was the promise that the bank would always step in, a promise that encourages the next crisis.